Hey, Cashflow Ninjas, real quick before we jump into today's episode. I've been asked by many people recently, what has been the one thing that has made all the difference on my journey as a business owner and investor? I started businesses and I've invested in businesses. I've invested in single family real estate, multifamily real estate. I still have a sizable portfolio of multifamily real estate, historic resorts, mobile home parks, oil and gas, life settlements, gold and silver, Bitcoin and cryptocurrencies. I could go on. But the one thing that has changed the financial trajectory for myself and my family has been infinite banking. Yes, you heard that correctly. That is the number one thing I've done over the past 2 decades that have made the single biggest difference. And it's not even close. Setting up and building out a family banking system using infinite banking has enabled me to create my own financial system. This year, it has allowed me to focus and not pay attention to all the chaos in the global economy and global financial markets. I really don't pay attention to all the noise about tariffs, trade wars, markets violently going down and then going back up, or interest rates skyrocketing and wrecking real estate deals and other alternative investment deals. Do not be beholden to other systems. Create your own system. If you're interested in working with me and my team at Producers Wealth to set up your own banking system or your own business and family banking system, then go to getwealthyforsure.com. That's getwealthyforsure.com. When you go to getwealthyforsure.com, you can request a free copy of my best-selling book, Get Wealthy for Sure. Only pay for shipping. You can also watch all of our presentations and schedule a call to explore infinite banking options with me and my team. You don't have to be powerless amidst the chaos. You too can have a financial strategy that provides certainty, predictability, and clarity. You and your family can also get wealthy for sure. Go to getwealthyforsure.com to start your journey today.
The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Laubscher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for joining me for another episode and spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. There's over 1,000 podcast episodes, 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. I've got a fantastic show for you today. I'm joined by real estate investor Brian Green. Brian, it's great to see you.
MC, thanks for having me.
Yeah, great to connect. I've been looking forward to our conversation and sharing you with my listeners and my viewers. For folks that don't know who you are and what you do, can you please share a little bit about your background and journey and what you're up to these days?
Sure. My name is Brian Green. My primary focus today is I'm a real estate developer. Green Springs Capital Group is our company name. We're located in upstate New York in the Albany MSA, but most of our focus is just north of that in Saratoga Springs and the surrounding area. My background originally was in retail, believe it or not. So I owned a chain of Verizon wireless stores all throughout the Northeast. Most of them in upstate New York, but they extended into Western Massachusetts and through Vermont. I operated that business for about 11 years right out of college. And then in 2014, I sold that company to a larger conglomerate of these Verizon stores out of Las Vegas. So I had a solid exit, and I used that cash that as kind of seed money for the real estate development deals that I'm doing today. And then I started buying like 3 months after I sold the old company, so I didn't take much of a break. But I kind of dove right in, started figuring out property management and investing in real estate, buying small multifamily properties, and then just started scaling for the last 10 years, bringing on multiple partners, including my brother, and now we're doing a myriad of complex type of development deals here in upstate New York.
Awesome, awesome. Now, New York. When we say New York, California, Illinois, American audience members, listeners, and viewers, they're already going, "Oof, you're doing business there, or you're investing there."
Yeah.
Talk about how much different, because New York State, one thing, you have New York City, but real estate is very local. And even in a state and even in a metropolitan area, right? And we'll get into why you're there and what you invest in. And this, by the way, is why I'm having Brian on, because I love challenging ideas and getting up the other side of it. And there's a compelling case for why there are great pockets to invest in states such as New York, such as California, and Illinois itself.
Yeah, I mean, so obviously it's a very blue state, just like California and Illinois and Washington State and a lot of places you mentioned. But at the same time, over the course of the last 100 years or so, there's been billions and billions of dollars made in real estate in those markets. So there is definite opportunity. The challenges are real as it extends to the tenant landlord relationship and those laws and kind of the intricacies of what you have to do to evict somebody. But to your point, the dynamic between places like New York City and where I am in upstate New York, 3 or 4 hours away, it's night and day, right? So if you look at just discounting the political part of it, right? Like most of upstate New York is very rural. It's there's farms, there's mountains, there's lakes. It's pretty red in general, other than the cities. So the landscape is actually pretty favorable here, and there's a great deal of opportunity. You just have to be able to operate within the rules that are provided to you, right? So I feel like it's almost a greater benefit to companies that are high level and skilled operators, because if you know how to operate within the rules and the kind of the lay of the land, you can be extremely successful, and it kind of weeds out the pretenders, right? That just want to buy a house, throw some tenants in it, and then they want to get bailed out and be able to evict somebody with almost no notice, which is what happens in a lot of red states, right? So you have to be a high level operator to be successful here. But if you are, and I believe that our company is, then there's tremendous rewards there as well.
It's also because of the kind of the idea of it, a lot of people won't even explore it, right? So you cut out a lot of the competition. And as you're saying, people that are there that are great operators and they run a very, very good button down business and execute, massive opportunities available still I mean, in any market. It's the concept of the acres of diamonds in your backyard, right?
Sure. Yep. And I think that, the side benefit is we also are not overly volatile. So, some of the stuff you're seeing in the southeast of the country now, or through Texas and in like Austin, those markets that, spiked tremendously for the last, 3 or 4 years during COVID. All of those are depressed markets right now, right? Like everyone's talking about how bad it is in Florida right now. And, Austin is down 20 to 25%. I'm in upstate New York, and we're turning rents over, at 10% annually still, right? So when they went up 20% in 2020, we might have went up 7 or 8, but we go up 7 or 8 every single year, and it just stacks on top of each other. So, I think, that the whole premise of like compounded returns, the whole Warren Buffett thing, nothing more powerful than compounding interest. Well, if you get 7 or 8% or even 5% every single year, and there's never a negative, I'll take that all day. Then like a couple of years of 20, then a year of negative 20, and then back up to, over time, you're going to be ahead further in a market like this that is consistent than in those markets that are highly volatile.
What does the economy look like where you're at too? Because I'm just thinking that if you look at population movement, right,
Mm-hmm.
and this sort of this exodus from New York City, these are all office jobs, tech job. Like, it's not people that are tied to the land and farms and have kind of like you. People use the term ugly businesses. I just say real businesses, people
Right.
doing stuff,
Yeah.
Those people don't necessarily move very quickly. It's easier for someone that's just going into an office and can work virtually to like leave a place, right? So what have you seen in your area from population, and what's the economy like there?
Yeah, a couple things there. So the same exodus that you're speaking of that I guess happened during COVID, right, from New York City, because there was a tremendous amount of people that were moving specifically from New York to Florida. The same element happened from people moving from New York City upstate, right? So the whole premise was to get out of the city, right? The city, the regulations, the illness, everyone being on top of each other, now having more flexibility in where you can work. So the same reasons they moved to Florida, they also moved to upstate New York, because now it's like, holy cow, I can only move 3 hours away, and I'm generally speaking still in the same state, the same Northeast region, which is fantastic weather-wise in the summer. And then if you like to ski in the mountains, that whole thing. So they got the best of that without having to relocate so far away. So we had that whole population upheaval going upstate as well. So we benefited tremendously from that. Secondarily, the Albany MSA in total, we're about the 50th largest in the country, driven by obviously state government, because Albany is the New York State capital. There's a ton of universities here. So we have the University at Albany, we've got Siena College, Skidmore College, Union College, RPI. So there's a huge driver of young talent that's coming out of those universities and colleges that stay in the market. And then specific to where I am in Saratoga, 10 minutes down the road is GlobalFoundries' largest chip manufacturing plant in the world. Huge, massive complex. So those are all high skilled, tech type positions. And all of those people live basically in the county surrounding that plant. And they're expanding that now even so. That on top of Saratoga, if you know anything about horse racing, is one of the biggest horse racing towns in the country. So after the Triple Crown races are all done, all of those horses, horse owners, everyone affiliated with the industry, they all come up to Saratoga for the summer. And we have about a 60-day racing season where the city's population triples. And all of that money comes in from all over the country and from all over the Northeast. So our economy is boosted by tourism, universities, colleges, state government, and private industry. It's like this whole I don't know what you want to call it, funnel, where everything kind of is, all those things mixed together turns into like this kind of like mirage, right? In the top of like the Rust Belt Northeast.
Yeah. No, what's interesting too is when you see the news headlines, you always hear, well, the great migration to Texas and to Florida. And yes, that is absolutely happening. The numbers speak for itself. But what is not reported in media too is that exactly what you're saying, is that there's also a ton of people that, let's just say they had family in the state that they're living in, that they don't necessarily want to move down to Florida and away from family. I'm just thinking if it's parents with young children and so forth. So they do move just to a different part of the state. Even here where I'm at in Bucks County, there's a ton of people from New York that moved into this area because within 20 minutes, you're in a train station, hour, on a express train, you're downtown, New York. But you live in Pennsylvania, amidst farms, in the middle of farms, right?
Yeah.
So there's a lot of pockets of geographical area that the people are moving to, besides just, the
the headlines, the low hanging fruit. Yeah, they're going to Florida, they're going to Texas, which yeah, they absolutely have. But there's other areas benefiting from these major cities and the terrible politics that exist in them, right?
Yeah, yeah. And you also have the secondary benefit of like, hey, we spoke originally about the politics of the market, right? So in the Northeast, traditionally very difficult place to build, right? Because zoning is very tight.
Mm.
Lot of NIMBYism, like, hey, everyone wants affordable housing except for when somebody wants to put it across the street from their own home. So, we have Northeast is, well known for that, right? So, I'm a developer, so yes, it takes forever for us to get a new project off the ground. The one we're constructing right now took about 20 months to get approved and about 25 board meetings with the city. So, it's a lengthy process. So the side benefit though is that um, supply is depressed, right? So like part of the reason why you're seeing rents or property values decline in places like the Southeast is because they built so much right over the last 5 years, and all of that inventory is coming on market, which is creating a supply and demand equilibrium where it's not allowing them to raise rents. They're actually dropping rents in some cases to fill units. In the Northeast, we don't have that problem because it's so difficult to build that we never get in a situation where supply is outstripping demand, even with the population trends, right? So, that also works against us and in our favor kind of simultaneously, which is kind of a weird dynamic, but that's kind of the reality of the market.
Yeah. So we talked about the economy. We've talked about kind of like the movements. And the other thing that's very, very interesting, and this is one of the things that I definitely wanted to share with my audience, is you got to look at everything that's available too. And one of the things that, just when we had a chat, when we first got introduced to each other, you were just sharing about all these grants and tax incentives that are available in that state, which
Yeah.
that doesn't get any play. I mean, I'm assuming that there were, and I know of opportunity zones, even in New
Yeah.
York City, right? You have
Yep.
opportunity zones, you have all that kind of stuff. But there's a whole world of incentives, of grants and tax benefits. So can you share a little bit more about that and how that
Sure.
plays into, what you're doing?
Sure. So anybody that's doing what I'm doing anywhere in the country knows that in the last 3 or 4 years, it's been very hard to find deals that pencil out. Interest rates are high. There's not a lot on the market. Sellers don't want to sell at prices that are less than what they could have got 2 years ago, right? So you have all these dynamics working against you. So what we started doing is, using every resource at our disposal to allow some of these projects to start working mathematically, right? So, because I'm a finance guy by background, so I need certain return requirements and metrics to hit so my investors can come on board and they're happy with the projects. So we started exploring a lot of tax credit programs with historic buildings. So most of the projects we're doing right now, I'd probably say the last 4 or 5 projects we did are all historic tax credit projects. And in New York State, that basically means that, there's a whole calculation you do, but effectively about 50 cents on the dollar of all the construction you're spending, you get back as tax credit. One portion of that is from New York State. The other portion of that is from the U.S. federal government. And we're actually using those tax credits as a return of capital for our investors. I'm sure you talk to a lot of people. I mean, if you told somebody, hey, I can either give you 20 grand or I'll give you a $20,000 tax credit, those things are equivalent, right? It's money. It's literally $20,000 less in taxes that you need to pay. So once we started figuring that structure out and kind of figuring out a way that we could do that within our syndication model, then it kind of unlocked the spreadsheet for us, for lack of a better term, right? Because now you have like, hey, all right, well, we're going to spend $3 million in construction and we're going to be able to give $1.5 million back in tax credits. If we utilize this as a return of capital to our investors, this thing is fantastic, right? So we just had to kind of explain the process to all of them, and it makes sense. Like as soon as you say it, like, hey, you can either give $100,000 to the IRS this year, or you can invest it in one of our projects, and you're going to be in the same spot either way, except for in this world, you own a part of the project now, right? Because effectively, you're either going to spend it one way or another, right? So might as well spend it on something that's an investment versus an expense. So historic tax credits are a big part of what we're doing. And then we also, on a recent project, New York State has a multitude of programs where they'll give grants. So one is a New York State Restore New York grant. So we actually found a project that we were closing on next month that already had a grant assigned to it, and then the current owner just couldn't make the numbers work on the project. But it was $1 million that New York had said, hey, if you develop this one piece of property and spend it within the prisms of what was approved, which is basically you got to spend $3.5 million on construction, which isn't going to be difficult on this building. We'll give you $1 million as soon as you're done. So I saw that it was listed on the public market, and they weren't listing it and advertising the grant. So once I figured out there was a grant on it, we were all in on that, and we should be closing on that project next month. So that one will have a grant for $1 million and historic tax credits. So you start stacking all these things on top of each other. The financials of these projects look fantastic when you get to the end of it.
Yeah, the first time I got a peek into that world actually was Donald Trump wrote about that in The Art of the Deal, right? That in his first project, the tax abatement and the tax issue in the city, that was the thing that was going to make or break the deal. So it's interesting when you started sharing this and how it plays into your model. It opens up a completely different world, and then of course, different market. And so it's a very, very intriguing story. Tell me a little bit about the syndication model. What type of projects you're involved with, and how do you plan and vet and do your due diligence and so forth on the projects?
Sure. So for the first 8 or 9 years we were in existence, we self-funded everything. So my brother and I are the primary partners in Green Springs Capital Group. We both came into this deal with a good amount of cash from our previous businesses and careers. So we would just self-fund everything. We owned 100%. We got to a point within the last probably year and a half where we came up to a project that was going to cost $15 million. And that was just outside of the scope of what we had in liquidity on our balance sheet, for lack of a better term. We didn't have enough money to do it ourselves. So we started exploring a syndication model. And that was the first time we had raised capital. So on that one, we raised just over $3 million. We do a 50-50 split with our investors because these are all very complex development projects. We're not just going to buy some 100-unit complex where we're going to throw down LVP and put in new counters and raise rents. Like, there's a lot more that goes into these projects. Like I said, 20 months to get the thing approved, 12 months to 15 months of construction, and then there's another 12 months of lease out. So like, these are very complex deals. So with that said, the returns are still good enough for the investors. Generally they're speaking, they're going to get somewhere around 18-20% IRR, generically speaking, on the projects, if not more. And our whole impetus is we want to return their capital as fast as possible, right? So if we can get them in that like infinite return model where they have no cash left in the deal, and we just deleverage the project for them, and then they still, maintain their ownership percentage, and then they can start accelerating their returns by reinvesting in future deals, and it's kind of like that snowball mechanism internally. But that's kind of how we got the syndications. It was just like, we want to do bigger projects, and the only way to do that is bring in outside capital.
Gotcha.
Yeah.
And then you walk me through the process of how you put together a deal, identify it, and then apply for approval, wait 20 months, get the approval, get that all started.
Yeah. So, I'm getting most of my deals sent to me at this point from brokers. Most of them are off market. There's almost nothing that's worth buying that's listed. Or if it is, I'm seeing it before it's listed, right? So like, those relationships with brokers are tremendous. We're almost exclusively multifamily. So generally speaking, I'm not doing office. I'm not doing mobile homes even. I'm not doing retail. So we have a very strict buy box. Generally speaking, we're only looking at the specific submarkets around our MSA. So we're avoiding like downtown Albany, downtown Schenectady. For the most part, we don't buy in downtown Troy. These are all like the old legacy inner city type areas that are around us. We're buying in all the suburban markets, where I call them places you want to live type areas. So that's our focus. So most of it's garden style. And we're either buying like existing stock that we can renovate because we own a commercial construction company as well. Or the bigger projects, we're starting to lean towards our ground up development type projects. But given our team and our structure, we kind of do everything in a vertically integrated way. So we own the development company, we own a property management company, we own the commercial construction company, and we own a real estate advisory firm that does all the financing for us and the bank debt. So we have a lot of skilled team members, I feel like, and the partnerships that we've kind of put together in the last 4 years are really going to be what springboards us into the future.
Yeah. That you guys are busy. That's a lot, that's a lot of
Yeah.
that's a lot of company. Because I
Yeah.
was going to ask
Yeah.
who you guys use in different kind of parts of the process, but it seems like everybody's on the same page because it's all under one umbrella, right?
Yeah, I mean, the way we have it is legally they're all structured as separate entities, but there's cross ownership, right? So, like, our partner that owns and operates the majority of the construction company also is a minority owner in our Green Springs Capital Group, and vice versa. My brother and I are minority owners in his construction company. So, yeah, we're all. It's kind of like a self fulfilling circular type of model. But we have partners in place, so I know that if I go to the construction company, I can trust those guys that they're going to value engineer that project upside and down, and make sure that we're not wasting any money, right? Because in the end, they're also benefiting from how good of an investment it is, right? Because they're also owners, right? So we have this whole circular type of relationship where we're helping each other and feeding off of it. And that gives us a level of control, right? So, there's a lot of developers that go out and they'll be like, all right, I'm just going to put the project together and then I'm going to outsource it to some other GC, and then we're going to sell it, or I'm going to outsource it to some other property management company. Every time you outsource, like, yeah, they might have some skill set, but like their priorities are not aligned with yours completely, right? Like the property management company, if you use an outside firm, their motivation is to generate as much income from that property for the property management company, which sometimes aligns with your interests and sometimes does not. So, I feel like we want to keep everything in house so we have some level of control over all these inputs, which so strongly affect in the end the value of the property.
What are you seeing currently in the landscape, just in multifamily? You mentioned that there's been a lot of deals that have gone south, right?
Mm-hmm.
Just because of the interest rates and experience and so forth. What do you see out there?
Well, most of those I feel like are people that, for lack of a better term, are trying to financially engineer the project, right? So like, hey, we can make 4% more if we put this on a variable debt or put this on bridge debt. And when you stress test that, you're never expecting rates to go from 3 to 8, right? But if it does, like, you're completely upside down and there's no way for you to get out of it. So we avoided all that, thankfully. The only floating rate debt we have is on construction on the front end, and then they all convert automatically to long-term debt at a fixed rate. So I feel like we have not seen in our market a tremendous amount of distress, probably for the reasons I spoke of earlier, where we don't have that huge volatility swing. Um, I feel like maybe in the Northeast we're a little bit more risk averse. It's older school or real estate. People are very comfortable locking in fixed rate debt. As you move south throughout the country, you're getting a lot of people that are investing out of market. And to my point, they can only make money if they buy more deals, right? Because they're not self-managing. They're not really developers. They're just people that can raise capital, and they may or may not know how to operate, a multifamily property. So, these are all just kind of generalities, and a lot of guys that are doing, are having some softness are much larger than we are, right? But like, I feel like there's a give and take there, right? I'd rather be slow and steady and start stacking our blocks on top of each other over time versus just running out and throwing down, on a 100-unit complex just because we can raise the money.
Yep. Yeah, well put. I always ask folks to, with their strategies, how does that? What are some of the risks that you have to manage? Like, how can things go wrong for what you guys are into?
A lot of ways. I mean, like I said, in construction, it's floating rate debt, right? So that the timeline between us going to get financing and a project finishing, that could be 2 years, right? So nobody knows what insurance or interest rates are going to be in 16 months from now, right? Like, so like there's huge risk there. We do have interest rate reserves built into our construction projects, so we mitigated a little bit there. And we kind of plan for the worst case scenario, right? So like on this ground up project we are doing now, we're like, all right, well, let's just assume rates are 7.5% for the whole thing. So if they go down to 7, fantastic. If they go up to 8, we're okay. Like, what I mean? So like, it's not outside the bounds of like what's possible. Now, if they go up to 10 or 12, we're talking a different game. But to this point, they haven't done that. there's always going to be some risk, right, with development, because you're planning for something that's going to happen in the future. I like to joke with my partners that there's never been a pro forma that's incorrect. So like they always make sense, right? The pro forma always
Right.
works out. Yeah. But in reality, like, all right, are you going to be, is your construction budget going to be on top of things? Like we like to carry, depending on the project, a 5 to 10% owner's contingency just to kind of absolve that. But you can still run through all that, right? And then now what are you doing when you're short on the budget? Usually it's like, okay, the owners have to throw in more cash. And then when you get done, the construction could be beautiful, but like, what's your lease out look like, right? Are you getting the rents that you thought you were going to get, or are they a little bit less, or are they a little bit more? So, specific to this project we're doing right now, we built in like 30 months of IO. So we gave ourselves a really long runway, and then it auto converts to a stable loan after that. Our plan is to bring it to Fannie Mae or Freddie Mac after the fact, just to get better terms. But our backup plan is to keep it with the local bank that it's with. So we're kind of mitigating in that we don't have to find financing when that 30 months expires, but it gives us a long runway.
Yeah. So you've got a couple of contingency plans A, B, and C in place. Because, I think that's a big lesson people have learned. If they haven't, this is what you should have learned about real estate is debt, right? Essentially. Yes, it has all the other ancillary benefits, and you're providing housing and so forth. But in the end, if your debt is not structured correctly, that's where a lot of people got clobbered, I would say, in the last 2 to 3 years.
Absolutely. Yeah. You can have the most pristine, beautiful, well-performing building in the world, and if your debt is incorrect, you could lose the building.
Yeah.
Yeah.
Not a fun way to do it. Yeah. And the other thing that we also talk about a lot on the show, so we talk about business, we talk about investing, we talk about cash flow and so forth. So I always ask my first-time guests if they cannot pass on any money to future generations, and they are only allowed to pass on 3 principles and values to them to build wealth and achieve success and happiness, what would it be? And it kind of ties into that concept of living and leaving a legacy.
Yeah. So we have 3 core values at our company that we kind of try to live by. It's how we go about our hiring process, how we promote, all those type of things. So I'll go with those then. So the first one is positive mindset, and that sounds kind of generic and hey, whatever. But really, what that comes down to is the biggest metaphor is like, hey, if we hire a contractor or somebody that's going to work in our company and they're the person that's constantly complaining, or like, hey, the weather sucks, or like, it doesn't even have to be anything with business. They're just always bringing the room down. Like, we don't want anything to do with that person, right? So like, we want to make sure that everyone has a positive mindset. And I think as long as you have that, you're always going to see you're going to be grateful for what you have, where you're going, what's possible. And I think that kind of clears the deck a little bit. So we want to focus on positive mindset. Internally, the second one we have is intrapreneurship. So I'll expand that out to entrepreneurship, right? If we're talking about legacy and money and that kind of stuff. I feel like the only way to really get to financial freedom, whatever that definition is for that individual, is to do it with an entrepreneurial mindset, right? It's very difficult to get to a place where you can say, hey, I have enough resources where I can do whatever I want on this day, whenever I want to. And the only way I know to get there is to own your own stuff, right? So like, you either own your own business, you start your own business, or our core value is entrepreneurship. Whereas if you could work for another company, which a lot of people do, right? Expand your ability within that company, right? How can you exceed the expectations of your role, right? So it's that entrepreneurial mindset where you're creating a business inside a business, right? And our partners now, effectively, we're like, hey, build up a real estate advisory firm. Okay, now we're going to spin that off. Now you own your own company inside our wheelhouse, right? Maybe you're really good at design, right? Or like project management. Okay, how do we monetize that and expand it past just being a property manager, right? So we want everyone to kind of lift themselves up and push past what the actual role is. And that's what we call entrepreneurship, but I think it also applies, just generically speaking, to entrepreneurship. And the last thing is do the right thing, right? So the easiest way we explain that is, what are you doing when nobody's watching, right? So in our world, we're sending out investor updates and budgets, and there's a world where you can sugarcoat a lot of different things and only selectively tell them what you want to tell them. But like for me, I do a monthly video update for our investors, and I just tell them everything. Like, hey, this project we're 200K over budget. right, this is the problem. This is how we got there. This is what we're doing to solve for it, right? Like, better to throw it out there and tell them what the problem is and how you're going to fix it than try to avoid it. And now you're at the end of the project and you're like, oh, by the way, we're $200,000 over. So now there's a cash call, or now you're not going to get the return you thought you were going to get. I'd rather tell you in month 6 than in month 60 what the problem is and how we're going to solve for it. And I think, we kind of try to emulate that all through our companies, but that's a big one for us.
Awesome. I appreciate you sharing that. Brian, this has been great. Really appreciate what you're sharing just on your strategy in New York and all of the other different things. Where can folks learn more about you? Where can they follow you? And where can they just stay informed and in touch and just look at all of the many different projects that you're involved with?
Sure. So our marketing team is going to yell at me if I don't tell you the website. So greenspringscapitalgroup.com. Our property management website is saratogastays.com. But I think the best way to reach me, if you actually want to get a hold of me, is brian@greenspringsco.com is my email address, or 518-810-2895 if you want to just send me a text or give me a call. Always happy to talk real estate, dive into some of our projects or anything else you want to speak about.
Awesome. Well, thank you so much for coming on the show and just sharing your journey and your knowledge and just providing so much value for all of my listeners and viewers.
MC, really appreciate you having me on.
And thank you to all of my listeners and my viewers for, again, spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. We've got over 1,000 podcast episodes. We have 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Until next time, live infinitely.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.